Welcome to GlobalSign's Women in Finance Special Edition. I'm Bruce Han. We've invited three outstanding finance professionals to our show today. Mani, it's so good seeing you again today.
It is. It's good to be here again.
G, thank you for joining us.
Thank you. Good to see you again too, Bruce.
Phyllis, thank you for joining us.
Thank you so much for having me.
Let's take a closer look at the stock market. Quantitative easing policies are coming to an end around the world, and there are now debates over interest rate hikes. As we're heading out of this low interest rate environment, what challenges do you foresee in terms of attractiveness in the developed, emerging, and Korean stock markets, and how should investors respond to interest rate hikes?
So the point to note about this current tapering is how well it is communicated to the market. So the Fed has done a wonderful job in laying out the timeline for the possible interest rate hikes, so the market is very well prepared. One of the examples of the current market situation is how 2 to 10-year Treasury yields have flattened over the past month. This shows that the market is expecting an interest rate hike sooner than later, and that the hike could potentially cap the future growth of the US. With that being said, I don't personally think that the interest rate will be increased twice next year, as the market currently assumes. Given the supply-driven nature of current inflation pressure, the inflation will come down second half of next year, giving Fed no more reason to increase interest rates further. Of course, this all depends on how the supply chain constraints, especially at the port level, will get resolved without any major hiccups. As for the emerging and Korean stock market, given how well it was communicated to the market, I do not see major shift from EM to DM. But the slowing down of the global economy, particularly in China, could act as a substantial risk for the Korean stock market, as it is very well exposed to the global economy. In terms of asset allocation for investors, I still believe cyclicals and commodities are the best place to be invested in right now. If you look at the current market setup across different asset classes, bond market is pointing towards a slower future growth, while the equity market is favoring the short duration names. So we are definitely seeing a mismatch between bond and equity markets. We never know which market is right or wrong, but given how commodities have been behaving recently, I would lean towards a reflationary trade rather than deflationary or stagflationary trade. Under such circumstances, as I always say, fundamental bottom-up analysis is more important than ever. And I would invest in those names that have fundamental competitiveness and secular tailwind behind them.
Now, Phyllis, the same question to you.
The Fed is signaling the end of quantitative easing, but they haven't put a specific date on it yet, given the ongoing supply chain issues and higher taxes, which have been a double whammy for the economy. The Fed said they will be patient, so I think interest rate hikes will most likely happen in the middle of 2022. As rates rise, valuations will come under pressure. Over the years, portfolios have become concentrated in secular, rate-sensitive growth stocks, but I think interest rate increases would have to be dramatic to hurt valuations. I think it's important to consider the volatility of risks and why rates are rising. Without any changes to the S&P 500's PE ratio, the 10-year yield would need to rise from its current levels of about 1.5% to 2.3% for equity values to be expensive relative to their long-term averages. If equities continue to be driven by earnings growth, then even if rates rise, equities will continue to appreciate. Rising interest rates are known to be bad for emerging market economies. They trigger capital outflows and increase debt burdens. Emerging market value stocks have outperformed growth stocks for the fourth consecutive quarter. And given that value stocks tend to be more cyclical, I think there's potential for positive performance to continue if both GDP growth and earnings growth stay on the expected track in the fourth quarter and coming year. In August, South Korea raised rates by 25 basis points to 0.75%, making South Korea the first developed economy to raise interest rates in the COVID era. The Kospi saw a boost after the Fed announcement in early November. And I think the global forecast for the Asian market suggests upside, with optimism over interest rates offset by weak crude oil prices.
And finally, Menyi, to you?
I actually see stagflation as the biggest risk to emerging market economies, which rely heavily on exports. We see the crazy freight prices earlier this year, and rallying raw materials have already put manufacturers under pressure. If they cannot successfully pass this through to output prices due to weakened demand, factory activity will weaken. We see signs of contracting PMIs. And if that's the case, we're likely to see lower returns across all asset classes, which means diversification may not necessarily protect your portfolios. Our solution to clients now is to allocate more to low beta strategy and reduce net market exposure.
G, what will be the impact of the new digital tax agreement on tech companies? Is this a negative for big tech?
So there has been an ongoing debate on how to properly tax tech giants that operate globally, but pay relatively little taxes to the major countries that they generate profits from. Given the digital nature of the companies and the services that they provide, some countries have come up with what is called a digital services tax. However, with the recent global tax agreement by OECD, it seems as those countries who had individually collected DSTs would stick to the minimum global tax rate of 15%. I do not expect this to be a major overhang for tech giants, as the investors who are investing in these names are largely doing so for their ability to create stable growth while maintaining certain level of operating margins so that they can invest in future growth projects. In the long run, it will act as a positive factor as it enlarges these big tech companies with the operation in each individual countries.
Phyllis, according to a recent survey conducted in the US, 53% of Americans cited inflation as their biggest concern. With concerns about inflation and even stagflation emerging, how should investors respond?
The Fed continues to deem inflation as transitory, despite consumer spending surges colliding with supply shortages. If global inflation anchors longer than expected, it could cause market uneasiness due to uncertainty about the pace of the global economic recovery. So most investors are looking for inflation hedges. Equities tend to do well in periods of rising inflation. And in the equity markets, there is a lot of focus on who and what can potentially benefit from rising inflation expectations. So this includes emerging markets, commodities, and typical investment safe havens.
Menyi, as vaccination rates increase globally, governments around the world are preparing for the living with corona era. How will the living with corona policy affect stock markets?
I believe the key is whether the governments can actually get us to resume our normal activities, right? So far, we see countries which attempted to relax COVID restrictions, like the UK and Singapore, they actually get a surge in infection. It seems that vaccines alone might not be able to contain the virus. So are people actually willing to live with that, or will the governments shut the city down again when cases surge will impact stock markets very differently? Let's say we can rely on the vaccine and the new medication to take care of us. Governments lift the preventive measures and borders open up. This can mean an explosion of social gatherings and traveling activities due to pent-up demand. And the past year here in Hong Kong, people are very much fatigued by online meetings and would love to go back to human interaction. Like myself, I would love to come to Seoul in person. So this would, of course, mean a recovery in stocks most affected by social distancing measures, like cruises, airlines, hotels, theme parks, etc. On the other hand, online platforms which benefited significantly from COVID might see slower growth and hence revised valuations.
Now, the final question is to all three. Phyllis, we're almost near the end of 2021. What sectors and stocks do you see as promising in 2022?
For US stocks, I want to start by recommending 3 travel-related company stocks. They are Delta, Airbnb, and Expedia. With the new COVID-19 pill announcements by both Pfizer and Merck, people will begin traveling for both entertainment and business again. It might take a little time to get back to pre-COVID levels, but I definitely see signs of positive mood and people's desires to travel. Delta is a major American airline company, and it's ranked second amongst the world's largest airlines by number of scheduled passengers carried, revenue passenger kilometers flown, and fleet size. Airbnb operates an online marketplace for lodging, primarily homestays for vacation rentals and tourism activities. Based in San Francisco, California, the platform is accessible via website and mobile app. Airbnb does not own any of the listed properties. Instead, it profits by receiving commission from each booking. And Expedia is an online travel shopping company for consumer and small business travel. I also want to recommend 3 stocks that may benefit from the development of the metaverse. The 3 stocks are Matterport, which is a nearly $6 billion company that specializes in 3D capturing for industries such as real estate, and NVIDIA, because they're already a leader in artificial intelligence and in the semiconductor space. Their chips and computer power are key to the metaverse. And finally, Roblox, because most of the innovation will come from gaming. And Roblox already has metaverse-like experiences. And for Korean stocks, I still recommend LG Energy Solution after its IPO in Q1 2022, and Samsung SDI. Both are excellent global EV battery makers, and both are aggressively investing and making inroads into the US market through joint ventures. So LV with GM and Samsung with Ford. And with continuing US and China trade tensions, I think Korean battery makers will be able to sell more batteries. I live in California, and California passed a law last year where by 2025, no gas cars will be allowed to be sold, and only EV cars will be on the road. And if California was an independent country, it would be ranked the 7th richest country in the world.
G, can you share your thoughts with our viewers?
So we are seeing a very interesting behavior in the US labor market. The unemployment rate is at an all-time low, but the participation rate is at an all-time low as well. So what this means is that people are willingly not going back to workplaces. This has resulted in historic number of job openings and overall wage inflation, especially in the labor-intensive industries. I am still trying to understand the fundamental reasons behind why people don't want to go back to work. But if this trend continues, I think manufacturing automation industry will benefit greatly from this new phenomenon. The increase in labor costs will definitely make manufacturing automation relatively more economical. Within that industry, Rockwell seems to be well-positioned given its competitiveness and value proposition in designing and maintenance of the whole automation chain.
And finally, Manyi, I want to ask you the same question.
Well, we favor stocks which can offer some protection against inflation, like commodities, right? Oil producers, for example, might benefit from continued recovery in demand and a supply shortfall. Drilling activities have been low, and these companies have been trading at depressed valuations. I think we can well see a rebound there. Also riding on the revival and tourism theme, I would like airports, hotels, retail malls, theme parks, etc. An example here would be Sheila Hotel, the nation's leading hospitality and duty-free operator. Now, there has been a lot of sell-off in this company in the past couple of years due to the gloomy tourism outlook. I believe that investors will revisit this stock once there are clear signs that we can start traveling without restrictions.
That does it for today's show. Thank you so much for joining us on today's special edition. As we enter the living with corona phase, please be ever vigilant, safe, and healthy.